Adam Jones from Morgan Stanley just increased his Tesla price target by 60% to $400 per share from a previous price target of $250 per share. And he upgraded his rating to overweight from equal weight, and Tesla is now their top pick. Adam Jones says, quote, "We believe that Dojo can add up to $500 billion to Tesla's enterprise value, expressed through a faster adoption rate in mobility, parentheses, robotaxi, and network services, SaaS." Let me tell you right now, $500 billion is almost the equivalent market cap that Tesla has today. So there's a lot of due diligence that Adam Jones did put out on Tesla that I think you need to hear as a Tesla stock investor. Now, do the markets like this news? Does this have a positive effect to Tesla stock? Well, I'll tell you right now, it can't be negative. But we'll talk about it more throughout this video. If you want to make more money, reach financial freedom, relax on the beach somewhere as fast as possible with your children, well, hit that like button as well as subscribe to the channel. We keep you updated and informed on everything you need to know with Tesla stock and the broader markets every single day. So before we get into the actual due diligence here and what Adam Jones is specifically modeling out, we have EPS targets, we have a lot of different things to go over. I just want to state how significant this is. It's not every day where a major Wall Street analyst like Adam Jones with Morgan Stanley raises a price target by 60% to $400 per share from a previous price target of $250 per share. He skipped the high 200s. He skipped all the way through 300 and went straight to $400. His bull case is Tesla stock over $500 per share. This is not a small move from Morgan Stanley, and I do think it will have an impact to Tesla stock. But again, this week is going to be a very volatile one, and we have a lot of economic data. So this will have a positive impact. And if we have a really good week, well, Tesla stock could see a big run this week. If the markets crash and burn, which is possible, this will have a minimal effect on Tesla stock. So that is your quick disclaimer here. Long term, this is great. Or really just within the next 3 to 12 months. These price targets, keep in mind, are 12-month price targets. These are not 5-year price targets. 12 months. And Morgan Stanley believes Tesla could be $400 to $500 plus per share. And I think before we get into the due diligence as well, we should point out Tesla stock is currently up over 2% in overnight trading. I would imagine it's because of this price target increase from Morgan Stanley. So let's go ahead and get into this due diligence. They start off this piece with saying, investors have long doubted whether Tesla is an auto company or a tech company. We believe it's both, but see the biggest value driver from here being software and services revenue. The same forces that have driven AWS to reach 70% of Amazon's total EBIT can work at Tesla, EBIT, earnings before interest, taxes. In our view, opening up new addressable markets that extend well beyond selling vehicles at a fixed price. The catalyst, Dojo, Tesla's custom supercomputing effort in the works for the past 5 years. Version 12 of Tesla's full self-driving system, OTA by year end, and Tesla's next AI day, early in 2024, are worth watching. And let me put this in the beginning of this video as well. This is really the first time we have heard an analyst speak constructively and positively on Dojo. We have never covered that in a video in recent times here on this channel. So it's quite refreshing to hear some realism that has finally struck at least one analyst on Wall Street. Adam Jones says, quote, "We believe that Dojo can add up to $500 billion to Tesla's enterprise value, expressed through a faster adoption rate in mobility and network services. The change drives our price target increase to $400 from $250 previously. We upgrade to overweight and make Tesla our top pick." What is Dojo? Dojo is a purpose-built supercomputer designed in-house by Tesla to train the full self-driving system that sits inside every Tesla vehicle. Why is Tesla doing it? Well, Tesla cars are sensor-encrusted robots making life and death decisions in highly unpredictable environments and driving situations. Tesla's ability to improve the efficiency of its full self-driving system is limited by the ability to collect and process real-world video data from the edge and to train these robots from the experience of its vehicle fleet in service, which is 5 units today and closer to 50 by the end of the decade. That means million units out on the road. That's a hint of what Morgan Stanley expects from Tesla. So that would be a 10x of essentially Teslas out there on the road. Tesla's management has said it needs as much compute power from NVIDIA GPU clusters it can get its hands on, and currently it cannot physically secure the amount of chips necessary to train cars. In addition, they believe they can develop a more efficient system for their specific needs while not funding a supplier's 60% gross margin. With a highly experienced semiconductor team, Tesla has built a custom AI ASIC chip that, due to its core function of processing vision-based data for autonomous driving use cases, can operate more efficiently, energy consumption and latency, than the leading cutting-edge general-purpose chips on the market, NVIDIA's A100 and H100 GPUs, and at a fraction of the cost. Dojo is a training computer made up of many thousands of D1 chips housed in an AI data center. It trains the inference engine, the FSD chip, that sits within the vehicle at the edge, which Tesla has designed in-house for the past 7 years. Tesla is not the first tech player to attempt to build a custom silicone system in-house. What's changed? Now, before we go further, I do want to point out Morgan Stanley's estimates for EPS, and they are actually quite conservative with this $400 price target that they are now giving Tesla. So for 2022, Tesla had an EPS of $4.07. For full year 2023, Morgan Stanley is expecting $3.26 of EPS. That's pretty conservative. Given the average estimate from analysts on Wall Street, as per the Wall Street Journal, the current estimate for Tesla's full year 2023 EPS is $3.35 per share. And the full year 2024 estimates are $4.75 of EPS for 2024. Morgan Stanley's 2024 EPS numbers are a lot more conservative than Wall Street, at a total $3.92 of EPS. So like 80 cents plus lower than Wall Street. And we'll talk about why here in just a second. Full year 2025 EPS, that's where Morgan Stanley expects this number to jump quite a bit to $5.58 of EPS. And the number one reason why I believe Morgan Stanley is expecting lower EPS numbers than the average analyst covering Tesla on Wall Street today is because I think Morgan Stanley thinks that a lot of Tesla's bottom line just revenue, bottom line income, bottom line profits are going to go into expanding the business. You guys got to remember this. Tesla would be a lot more profitable right now if we were not expanding Giga Berlin, Giga Texas, about to build Giga Mexico, or creating all of these showrooms and building all of these superchargers. That would be a lot more profits recognized to the bottom line. But Tesla cannot recognize those profits if they're spending out this money to build Tesla. And that's what's important. if you don't innovate, if you don't invest today, well, sure, your numbers are going to look a lot better today, but what are they going to look 5 years from now, or 2 years from now, or 3 years? They're not going to look great because you were not investing the whole time. So odds are your revenue, your net income does not continue to improve. So you actually want to see as much investment as possible from Tesla, and that does mean in the short term maybe lower EPS, but it's one of those things where the markets understand if EPS is low because of a company investing. And I think, at least maybe not recently, but over the next 12 months, markets will start to appreciate Tesla investing and a lower EPS a lot more than they have over the previous 12 months or so. Morgan Stanley goes on to say, what's unique about Tesla is the company's longtime experience with advanced driver assist systems. It has commercially a vast network of vehicles that is constantly increasing, 400,000 plus FSDs on the road already, collecting data from 300 plus million miles traveled. In addition, the company has brought together a world-class design team and has allocated expansive resources towards the autonomy problem. Like other tech platforms, Tesla pursues high vertical integration in key technology domains to enable high integration and continual improvement while helping to diversify away from over-reliance on third-party suppliers that may not be able to provide an optimal solution for Tesla's specific needs. While it is difficult to explicitly validate the many claims that Tesla's made about Dojo's cost and performance, we believe Tesla has a chance of bringing forth a competitive, customized solution given the company's innovation, track record, and capabilities. In this report, we present a comprehensive primer on Dojo involving insights and opinions across Morgan Stanley's AI/semis research teams. We explore what Dojo is, why Tesla is doing it, and how it can impact the business and the stock's valuation. We invite investors to dive into the world of custom silicon at exaflop scale, solving some of the world's most challenging problems, in parentheses, autonomy, offering a gateway into vast, untapped commercial potential, essentially everything with a camera that can process data to make decisions. The more we looked at Dojo, the more we realized the potential for underappreciated value in the stock. Like many other large cap tech stocks on our screen, we believe Tesla can reasonably test its all-time highs of $400 over the next 12 months. Boom. And down here we have this picture of Tesla in the middle with its Dojo chip, and you have massive amount of data capture, world's top talent, world's hardest compute/software problem, autonomy, unlimited access to capital, vertical integration, hardware plus software. For years, we've tried to focus investor attention on the potential of Tesla's leadership in EV hardware, semi-autonomous electric robots, to convert vehicle owners into subscribers, generating highly recurring and high-margin revenue. While Tesla has had some modicum of success on this front to date, we believe Tesla's in-house computing efforts have the potential to materially accelerate the network effect and speed of data capture/analysis/learning from the 1 billion miles traveled per day we forecast is executed by its global fleet, Tesla plus the third party, by 2027. The scale and complexity of the data, the collective global light vehicle fleet, travels a distance of nearly 2 light years annually. Combined with the high standard of safety requirement, make the global mobility market highly relevant territory for the expression of the AI investment theme. Notice what Morgan Stanley said here, and I will go very close so everyone can see. Tesla plus third party by 2027. So they are saying right here that Tesla could end up licensing its full self-driving technology. That's insane. What could be even crazier is the amount of miles that are being traveled on Tesla vehicles. 1 light year is equivalent to 6 trillion miles. The total circumference of the planet is 24,901 miles. This means that Tesla vehicles today roughly travel around the world in miles driven every year 481,908,357 times every single year. That's almost 500 million travels around the world every year. That's a lot of data to train FSD. Morgan Stanley has put together this, I guess, analogy, if you will, of Tesla's auto and SaaS double flywheel. This is how these two business models could really feed into each other. And it starts with sales, goes into price, improved design, capacity, cost, to profits, and then those profits into a monthly user base, to software service revenue, data insights, user experience, platform stickiness, affordability, and back to monthly user base, and then ultimately back to profits. Morgan Stanley collaborated with a range of AI experts at Morgan Stanley to weigh in on Tesla's AI ambitions and to compare and contrast them to those of Nvidia and other hyperscalers, extending beyond the implications for Tesla. We hope this work sheds light on the potential of the broader custom silicon market. And it says basically what's changed before and after Dojo. Before Dojo, industry target was automotive. After Dojo, Tesla's target kind of industry is multi-industry, many different branches to Tesla's business. AI training speed, well, before Dojo, about a month. After Dojo, well, Dojo can basically speed up the training of AI by about 4x and do what Tesla's GPU cluster could have done in a month, and now do that in a week. CapEx, high single digit. Now, low single digits. Energy usage, inefficient. Now it's efficient. Data processing was a cost, and now it's potentially revenue. In conjunction with this report, we feel it is prudent to include a degree of optionality for Tesla's AI potential into our revised price target, which has increased to $400 versus $250 previously. Our bull case valuation is raised to $550 versus $450, and our bear case valuation is raised to $120 versus $90. Within our forecast and valuation, we express the potential of Dojo through our raised assumptions, primarily for Tesla mobility, autonomous robo-taxis, and Tesla's network services, the SaaS business derived from Tesla vehicles and third-party customers, in the form of faster adoption and higher ARPU. And that is average revenue per user. We share a comprehensive review of Tesla's valuation on our new earnings forecasts, which have increased approximately 20% by full year 2025 through 2026, which we believe fairly underpins our $400 price target versus the growth and valuation multiples of the relevant tech peer group. So basically what they're saying here, I'm going to go ahead and read this. But then these bigger paragraphs are really summarized by these charts. So let's just go over this part right here. It says, we believe Dojo can represent the next step change in market perception of Tesla. Dojo emphasizes three of Tesla's core capabilities: speed, performance, and cost. In the near term, we believe Dojo can accelerate the development and monetization of Tesla's software and services business. Longer term, we see scope for Dojo to provide revenues for Tesla's software and hardware capabilities to extend well beyond the auto industry. If Dojo can help make cars see and react, what other markets could open up? Think of any device at the edge with a camera that makes real-time decisions based on its vision field. And I really like this point because a lot of analysts and a lot of Wall Street cannot see just what's out there, right? When phones, for an example, when you had your button phones and there was no screen or no touch screen, well, when Steve Jobs introduced the iPhone in 2007, a lot of people did not like the iPhone because they were not visionary. They could not see the possibilities here. And there was gaming systems at the time, like it, relatively speaking, should have been pretty easy to see the path ahead for phones, given we already had computers at the time. You could already play games. I mean, I believe like San Andreas was out. I played that game like crazy when I was a young kid. Like, it should have been easy to see, is my point. At least one analyst out here sees the potential opportunity longer term beyond the auto industry for Dojo. Now, in this Exhibit 4, Tesla claims of 6x performance improvements imply multi-billion-dollar cost savings from Dojo. And it says the cost of 100 exaflops with A100s. And that cost is about 8 billion almost. And it says the cost of 100 exaflops with Dojo, it's about 1.6 billion. So that's a cost savings of, in total, about $6.5 billion. What's actually interesting about this new price target increase is Morgan Stanley says we made no change to our assumptions for Tesla's energy or Tesla insurance. The modest $7 a share increase in value of the core auto business was mostly related to an increase in our exit EBITDA multiple assumption to 13x from 12x previously. Our near-term full year 2023, full year 2024 core auto assumptions for volume and gross operating margins were unchanged. It says Dojo's impact on Tesla mobility and network services drives 86% of our new price target change. I also would like to point out that Morgan Stanley added $0 to Tesla's share price based on energy, in which energy is growing 200+% a year. If this continues, energy is going to become a massive portion of Tesla's business and long term could become, 20, 30 to 50% of Tesla's overall revenues and bottom line profits. And this, I think, is very conservative from Morgan Stanley, baking in $0 of benefit to Tesla's energy business over the next 12 months. Morgan Stanley says, stretch your thinking. Could success in vehicle autonomy enable Tesla to become a go-to provider for visual data processing across other adjacent markets? Although Dojo is still early in its development, we believe that its applications long-term can extend beyond the auto industry. Dojo is designed to process visual data, which can lay the foundation for non-vision-based AI models, such as robotics, healthcare, and security. In our view, Tesla makes headway on autonomy and software. Third-party Dojo services can offer investors the next leg of Tesla's growth story. This is by far the most bullish piece from any analyst I have seen really ever, long-term speaking. They're not just talking about right now. They're talking about Dojo being a major competitor to Amazon, really creating an industry in and of themselves within the next 5, 10 plus years. When autonomy gets solved, what else can that help solve? I think that's a real question that Wall Street has not asked themselves. And I think for all of the information that was provided to you here in this video, it's something you really needed to know. So, I know this video is a longer video, so we're going to end it here. Let me know what you think about this and how this could impact Tesla this week or over the next multi-years or multi-months. Let me know what you think down below in the comment section. Personally, I still believe you want to be fully long in Tesla once the Cybertruck starts deliveries, as long as we don't get a deep recession. Tesla stock is already forecasted as far as estimates for 27% delivery, 29% EPS growth, as if there's a recession coming. So you don't have high expectations for 2024. Seasonally, this is a weak time for the markets, so I wouldn't be surprised if we do get some weakness over the next couple of weeks. But by 2024, I strongly believe you want to be fully long in Tesla stock, and apparently Morgan Stanley believes so as well. So that's going to do it for this video. If you want to make more money, reach financial freedom, and grow your net worth as quickly as possible, we at the very least keep you up to date and up to speed on everything going on with Tesla stock as well as the broader markets each and every single day for the low cost of free $99. Thank you for watching. My name is Michael Tyler, and I will see you in the next one.